Imagine you open your credit card statement and see a balance of $5,000. Then right underneath it, you see something comforting. Minimum payment, $150. It doesn't look terrifying. It looks manageable. You might even think, I can handle that. But here's the trap. The minimum payment is designed to keep your account in good standing, not to get you out of debt quickly. And once you understand what happens behind that tiny number, a credit card balance can start looking very different. Let's say you owe $5,000 at a high interest rate. Every month, interest is added to what you already owe. When you make only the minimum payment, a significant portion of that payment can go toward interest before it meaningfully reduces the original balance. So you pay, then you pay again, and again. Yet the balance can move painfully slowly. That's where the psychological trick becomes powerful. Your brain doesn't experience a $5,000 debt as one giant problem when the screen keeps showing you a small monthly number. Instead of thinking, I owe $5,000, you start thinking, I only need to find $150. The debt hasn't become smaller psychologically. Your perception of it has, and credit card companies understand this behavior. Minimum payments reduce the immediate pain of spending. A purchase that feels too expensive at $1,000 can suddenly feel acceptable when you imagine paying it back in small pieces. But there is another problem. Minimum payments can create the illusion that you are making progress simply because money is leaving your bank account. You see a payment completed, you feel responsible, you feel like the debt is under control. But if interest keeps eating a large part of every payment, progress can be much slower than you expect. That's why the interest rate matters so much. Imagine two people each carry a $5,000 balance. One aggressively pays down the balance every month. The other makes only the minimum payment and continues using the card. Both are technically making payments. But they are playing completely different financial games. The first person is trying to destroy the balance. The second may be spending years fighting the interest attached to it. And here's where the trap gets even deeper. The problem isn't always one huge purchase. Sometimes it's dozens of ordinary purchases quietly accumulating behind a convenient payment system. A meal here, a subscription there, a new phone, a weekend trip. Nothing feels catastrophic individually. Together, they can create a balance that becomes surprisingly difficult to escape. So what should you do? First, stop thinking about the minimum payment as your debt goal. Think of it as the emergency floor, the amount that prevents you from falling further behind depending on your card's terms. Second, look at the interest rate and the actual payoff information on your statement. Don't just look at the monthly payment. Look at how long repayment could take and how much interest could be charged. Third, stop adding new purchases to a balance you're trying to eliminate. If your goal is to get out of debt, continuing to spend on the same card is like trying to empty a bathtub while the faucet stays open. Now, this doesn't mean credit cards are automatically bad. Used strategically, they can be useful financial tools. The key is whether you're controlling the card or whether the card is controlling your spending. If you can pay your balance in full, avoid unnecessary interest, and use rewards without changing your spending habits, the equation changes. That's the real lesson. Credit isn't free money. It's borrowed purchasing power. Use it deliberately, understand the cost, and make the system work for you.